Yes, go ahead, David. Thanks.
Thanks. Go ahead, then, please. Next slide. Okay, so basically one of the key things that we talk about when, as an accountant, when I'm talking to an owner-manager at the end of the year, is the concept of whether to pay yourself a salary or a dividend. And this is, probably misunderstood by a lot of business owners, I find. And one of the key things that an accountant is going to walk them through is something that they call a tax integration test. And what it says is there's kind of a couple different ways that you can take your money out of a company. One is by dividends. And so you leave the money in the company and pay the taxes, corporate taxes on it, and then pay yourself out as a dividend at the end of the year. The second is to take that income that would be taxed in the company, pay it to yourself as a salary or bonus, pay the personal tax on that, and because you've already made that expense to the company, there's no income, you avoid the corporate tax and you basically just pay a personal tax. And the third scenario that we're going to look at in the after-tax result is what if we pay, instead of a regular salary or bonus, what if 100% of that time of the individual is qualifying SR&ED salary to the owner? Okay? And what would be the net tax effect after tax cash in your pocket under each of those three scenarios? Thanks. So what we have here is a first situation where we have a salary of $1,000, and in scenario one, we're going to leave it in the corporation. Now, we're going to assume this is an Ontario corporation. In Ontario, corporations pay a corporate tax rate on the first $500,000 of income of 12.2% combined federal and provincial rates. And after that, it'll go up to 25 to 26.5%. We'll assume it's 26.5% for our calculations. So there's an incentive, as we're going to illustrate, to have income over $500,000 paid out or bonused out to owner managers. And we'll talk about why that is here. So we see under the two scenarios that if the income's under $500,000 and we earn $1,000, the tax rate in Ontario at the corporation would be 12.2%. So we'd have after taxes $878. If we assume the maximum personal tax in Ontario on the dividend, if and when it's paid out. Now that tax is only payable when the dividend is paid, so it can be paid this year, it can be paid 20 years from now. So there's what we call a deferral and a time value of money assumption in this. But ultimately when that dividend is paid, assuming that the tax rates are similar than they are this year, we're going to have a maximum rate of 44% on the dividend, so we'll have a net after tax of around $492. Under scenario two, assuming we're in roughly the top marginal tax rate in Ontario of around 50%, we'll pay $1,000 salary, we'll have 50% personal tax, and we'll have a net after tax of $500. So effectively what we have is two things. We have a deferral of tax, because under scenario one, we have $878 until we decide to pay out that dividend, which may be this year, maybe 20 years from now, as we said. So we have a deferral of tax of $378. We have the $878 versus scenario two, the $500. Okay? But ultimately, at the end of the day, there's a net cost of $8. And really, that's really a difference between when the federal tax rates are set up, when the federal rules are set up, and these are federal rules, they assume that the provinces are always going to be a certain percentage. So the fact that it's not exactly zero is, and it will vary from province to province, is really a difference of the provincial rates versus what was expected when the federalization was done. But ultimately, it should amount to almost zero. So the result being that an owner-manager on income under $500,000 should be ambivalent between getting it as salary or paying it out as a dividend. As the income goes over $500,000, we walk through the same scenario, we can see that there's actually a cost to not bonusing out that income. It's roughly 8.8% in this case. Okay? So this is assuming that it's salary or dividend without any SR&ED credit, so that the $1,000 that's paid has no SR&ED involvement, and this is how it would work for most companies. Okay. Next, please. Okay, so as we mentioned there's two major effects here. Not, oh, sorry. What we're going to talk about is, on the next slide, is that there's two major effects. We can have a negative deferral of tax, and we can have a permanent tax savings. Okay, so we're going to illustrate that in the next slide. Okay, can you go back 2 slides, Earl? I think we might have skipped one. Yeah, I'm sorry. Let me just talk about this slide. Sorry, we've jumped over this. So let's go back to our previous example, and now we'll assume that the $1,000 that we spent was SR&ED wages. So we'll talk about it, but ultimately we can get up to 66% of what we paid back in an ideal scenario. What that would mean is that we have the $1,000 of shred wages, we have an increase of income of $660. We're going to have to pay tax at the 12.5% or 26% on that those credits when earned, which gives us an extra $579 available for dividend. If we assume that 44% tax on that dividend, or $244, we have a net increase after tax cash of $325 versus the scenario 1 on the previous screen. Okay. If we add that to the fact that we also have now the salary that we wouldn't have had before, even if the tax rate's 50%, we have $500 from that, meaning after tax we have $825, meaning that we have $825 versus the $492 under scenario 1 if we paid it as a dividend with no SR&ED, meaning that the ultimate savings was $333. Furthermore, because we get those credits, basically the $660 of credits, even after tax, there is no deferral of tax. There's actually a prepayment of tax by not claiming the SR&ED credits in this case. Okay. So going back to highlight what the last slide said, that ultimately there's not any deferral of tax in this case. In fact, there's a prepayment of tax if we assume that an employee is 100% SR&ED, and there's a permanent tax savings of 33 to 36%, depending whether we're under the $500,000 small business limit or over. So ultimately, the question is, where's that extra money coming from in the first place? And really, what we have is what would have been $1,000 in corporate profit that would ultimately have to be paid out as a dividend, so it attract corporate tax and personal tax. We pay it as a salary. The government's giving us back up to 66% of that as an investment tax credit, and those refundable ITCs, after going through that calculation, result in the $825 ideally in your pocket versus the $492 if we just paid it as a dividend. Okay. So this is kind of a complicated schedule. It's just really meant to highlight what the rules are related to salary and wages, both for an owner-manager, what they call a specified employee. That's any employee who owns 10% or more of any class of stock of the corporation, or anyone related to them by blood, marriage, or adoption. So the owner's, son or daughter who maybe works there part-time, they might be caught by these rules as well. And basically what it does is it includes all your salary and wages, but it excludes any bonuses or remuneration based on profit. So one of the key things is that rather than bonus, as we said, rather than bonusing out income at the end of the year, what we know when the income is, and bringing it down to $500,000, if we're doing SR&ED, you want to be more proactive and salary out that income. So trying to predict what your income is going to be and set your salary high enough that we can max out the tax credits if need be. So one of the key things that that applies to specified employees is that there's a limit both for a calculation of the wages itself. It's 5 times yearly maximum pensionable earnings, which is around $375,000, let's say, for 2026, and a limit for something called the salary base, which represents the overhead that you can calculate your ITCs on, of 2.5 times YMP. So these various limits are kind of the limits that we would drive to in optimizing the SR&D salary for a specified employee. Okay. So as we said, those limits would be ultimately for shred labor for 2026, 373,000, and for calculating your ITCs on what they call proxy or the overhead allocation, it would be half of that, or 186,000, meaning that the total amount of qualified expenditures that a shred specified employee could get for 2026 is roughly $535,000. Okay. So, in addition to the tax benefits that we illustrated, one of the other things that paying the salary out, whether we're doing SR&ED or not, or one of the factors that you might want to consider is that you don't want your corporation to be deemed to be a specified investment business. And that's basically any business who earns the principal amount of its income from investments or property rather than from active business. One of the ways around that is if you have more than 5 full-time employees. But ultimately, I've seen this in cases where you have active business with too much passive investment building up year after year after year, where you get perhaps millions of dollars of income that's not arguably actively needed for the business. The government really wants you to remove that money. So these rules are put in here to encourage you to take that money out either as a dividend or to pay the personal tax on it and not leave it within the corporation unless, again, it can be tied to active business. Okay. Go ahead. So part of the negative effects of being a specified investment business is you lose your small business deduction, so you pay the top rate of tax, as you said, the 26.5%. You lose refundable SR&ED credits, so you no longer qualify for that. And you're going to have a higher combined rate as well. You're going to pay basically a temporary tax on all your investment income until it's ultimately paid out. So again, paying out salary usually helps to remove some of these passive assets from the company. Okay. Now, applying this to a medical scenario, we've talked about the issues related to medical practitioner corporations or dental or professional corporations over the past couple of years, and there was a whole series of issues that were in contention from 2016 to 2021. One of the issues that we'll talk about real quick here is, is there any funding or assistance being paid to the medical corporation, professional corporation, or dental professional corporation for the research that's being done? Are you directly entitled to exploit it? This was solved by a case in the past, case of Dr. Lamy in the Hamilton Health Sciences Center. It was a landmark case, so it solved most of these problems. And one of the key things it illustrated is, and an issue of contention now is, do we have input on protocols? And where doctors may be part of a peer-reviewed paper, but a series of doctors, maybe there's dozens or hundreds of them, the real question would be, did you really have input on the protocols? Were you involved in the design of it? Or did they maybe hire you because they want access to your client data and you were more or less just collecting data for them and someone else was interpreting what that meant? Okay, so really as long as you can show involvement on the protocols, that's one of the key things that we have still to document. Okay, so as we said, some of the key factors that we're looking at now is improving or proving and documenting what involvement you had if you're part of a multi-person study or peer-reviewed paper. And if you can detail that within the scope of the paper itself, generally that type of work would be eligible. Okay. The other issue that's still in contention is, did the Medical Professional Corporation receive any direct funding for that work? So generally speaking, if you look at the funding, most researchers, especially in universities or research hospital situations, have a contract where they're doing both clinical work and research work. And generally, most of the funding that they get is for the clinical work. So often there's no funding for the research work, or they're just expected to do it as part of their involvement with that research organization. In some other cases, it may be arguable that they were paid for the research. And the way the CRA looks at it is they'll look at something called the APP or AFP, what they mean, alternate funding. And the issue with alternate funding is that often it's supposed to pay for a whole series of things, such as being a specialist, working in remote areas, working overtime, working off hours, and research and development. So it's hard to argue that all of the AFP were related to it. But currently now, one of the main issues is should any amount or some reasonable amount of AFP be related as a payment or a contract payment or reduction of the ultimate expenses that we claim. Okay. Some of the other things that we'll talk about is that the assumptions that we used here assume that you're in the top marginal tax bracket. So if you're in a lower bracket, that ultimately you could adjust those numbers to reflect your real situation. Okay, and I've just provided the rates that we've used for the corporate taxes as well. Okay, so again, those what we've done is also provided in the downloads a series of workbook tables, so you can adjust the percentage of time, marginal rates, and discount value of money to determine the net tax effects. Thank you.
Thank you, David.